Podcast is now starting. All attendees are in listen-only mode.
Hello, good afternoon, and welcome back. This is Anthony Newgrosh from BKL. I'm delighted and somewhat relieved to say that David Wiscombe, my learned colleague, is here today with me. David, what are we talking about today?
I don't know really. What would you like to talk about?
Well, I thought we should talk about partnerships.
Okay, then we'll talk about partnerships. We'll talk about some aspects of partnership taxation. Partnership taxation is a huge subject, of course. Sort of thing you could write a book about.
Could you? Have you?
Well, funnily enough, Bloomsbury Professional have just published the 2018-19 edition of Partnership Taxation, a volume of 300 odd pages, no, nearly 400 pages. It's strongly recommended. Modesty forbids me to disclose the name of the author, but it's available from all good bookshops and direct from Bloomsbury Professional, and I don't get commission.
And no doubt on Amazon too, I'm sure.
Yes. You might have to look quite a long way down the best-selling lists on Amazon. So we're going to talk about partnership tax, or some aspects of partnership taxation. Looking through the topics on the agenda, these are picked out more or less at random as some of the items I thought might be of more interest than others. But as we were saying just before we started this webinar, there are a lot of aspects that we'll not be covering today, and maybe we need to timetable a second session, or maybe even a third session, to deal with some of the other exciting aspects.
Okay, so we'll call this Aspects of Partnership Taxation Part 1.
Part 1.
Okay. Yes. And I should say, as always, we welcome your comments and questions, so please feel free to type away. We'll endeavour to answer those that we can during the webinar. If we miss any, apologies. Those that we can, if I don't press the wrong button, we'll try and come back to you after the webinar as well. But if you have any comments or thoughts, or would like us to try and clarify anything as we go along, please do type away, and we'll do our best to deal with them there and then.
And if we don't like them, we'll just ignore them.
Absolutely.
Yes. So what are we talking about today? We're talking about fixed share partners. These are what might be called salaried partners, fixed profit partners, both in the context of what I'll call conventional partnerships, and also LLPs, where there's some special rules. Some interesting aspects of enquiries, that is revenue inquiries into partnership tax returns, and some changes that have gone through in FA 18. Talk a bit about mixed member partnerships and what we mean by them, and what the consequences of having them are. Talk a bit about personal expenses of partners, that is expenses incurred personally by partners, not expenses of partners that
understood, yes,
to do with partnership. And we'll delve a little bit into CGT on partnership changes. So there's quite a lot to get through in just on those 5 topics.
Okay.
So
no, thank you, David, for your comment. We will suitably ignore that. Yes, it is a rather large volume. I can hasten to add partnership taxation.
Yes, I think if you wedge it under your desk leg, it should stop it from rocking. Yes.
Enough said. Okay, so on we bravely march. Let's start by talking about partners. What are they? What's their legal status, David? And a few developments here, haven't there?
There have indeed, yes. So can you be a partner? Can you be an employee? What's the difference? Well, the difference in when you're looking at the status of what we call fixed share partners or salaried partners, as between partnerships, conventional partnerships and LLPs, is that in a conventional partnership, it's the definition of a partnership is, of course, the relationship that subsists between persons carrying on a business in common with a view of profit.
Okay.
And it's a question of fact whether you are one of the persons carrying on the business or whether you are an employee of the persons carrying on the business. And in determining your status as a partner or employee, it's exactly the same criteria apply as to any other relationship between a putative principal and a putative self-employed person. So, do you look like an employee? Are you? To what extent are you subject to direction and control and all the rest of it? So in relation to partnerships, conventional partnerships, the same criteria apply as to any other employment relationship. Now, in relation to LLPs, there has been the revenue have taken the entrenched view that LLP members members of an LLP have a status that is different from employee, and members of an LLP cannot be employees. So there is in fact a case called Tiffin and Lester Aldridge, which held the contrary, that held that a person who was a member of an LLP was in fact also an employee of the LLP, but the revenue never really accepted that case, which meant that there was a very obvious way of avoiding national insurance, employers' national insurance, but by making people members of an LLP, and therefore they couldn't be employees, therefore you didn't have employers' national insurance and all the rest of it.
So this was the wheeze about making Betty the receptionist a member of the LLP, although she very much walked and talked like an employee. The argument was, well, she's a member of the LLP, therefore she gets paid as a partner and no employer's NIC.
Exactly, and at the other end of the spectrum, you might have a business that pays very high levels of remuneration to people who look very much like employees, but particularly partnerships in the city, perhaps in the financial sector, and again, avoiding NIC by setting those up as LLPs was rife. So legislation comes in to it applies only to LLPs, which says that any member of an LLP is treated as an employee. The default position is any member is treated as an employee unless one of three conditions is breached. So we need to look at what the three conditions are.
So these were the salaried partner rules that were announced, I think, the end of December 13, weren't they, David?
These are indeed those rules, and basically these three conditions pick out essentially the characteristics of being a partner rather than an employee. So, do you get a share of profit? Essentially, are you one of the bosses of the business? Do you call the shots? Or do you have capital at risk? So if you meet any of those three conditions, and they are more specifically defined in the legislation, of course, if you meet one of those three conditions, then you are capable of being not an employee. If you don't meet any of those conditions, then you are treated as if you were an employee. And it's important to note that although those are in principle the same sort of they pull out the same sort of factors as apply to employees, you could very well be in the position where a member of an ordinary partnership, where you have a member of an ordinary partnership and a member of an LLP, where the relationship between the partnership and the individual is exactly the same, but the employment rules might be satisfied for one, but the deemed employment rules might not be satisfied for the other. They're a different set of rules. So let's have a quick look at the rules.
Okay. If our friends are playing along at home, David, where are these rules if they want to thumb through?
Toya 2005, section
863, isn't it?
6.3. You ask me these difficult questions.
Sorry.
It's you've looked this up beforehand, haven't you? 863, is it?
I think so.
If that's what you say.
Oh, I think
863 et sec, and then the conditions are set out in 863 A, B, C, D, E, and the rest of them.
All right, so let's have a look at those conditions in a little bit more detail. Let's be slightly controversial and start with condition B, shall we?
Yeah, because I'm looking at these in sort of order of simplicity. So
right.
Condition B, simply, do you have significant influence over the affairs of the partnership? And it's no more closely defined than that. So in most small partnerships, LLPs, where you've only got 3 or 4 members, then probably everybody has significant influence over the affairs of the partnership. If you're in a large partnership, and large is subjective, then probably not, unless you're on the management board. In some cases, you may not have much influence even if you are on the management board, frankly. But question of fact, whether you have significant influence over the affairs of the partnership.
So if you're a partner in PwC, you wouldn't satisfy that test unless you're on the management board.
Your average normal partner in PwC, who's just sitting at his desk, knocking along, picking up his £1 million a year, hard life, would probably not satisfy the test. Management board would. Management board probably would. Significant influence over a limited area of the partnership doesn't count. So imagine you have an LLP where perhaps you have a chap who is a partner who is in charge of the entire tax practice of someone like you, for example. That you might have absolute dominant influence over an area of the partnership business, but that isn't significant influence over the affairs of the partnership as a whole. So question of fact, and probably not the easiest condition to get around.
No, it's very subjective, isn't it? And as you said, there's no definitive line where we can say what size of partnership you're probably okay. So if it's a 20-partner firm, I think it's a difficult call, isn't it? Do you have influence over the partnership as a whole? Where I don't know where the dividing line is, and I'm not aware we've seen anything from HMRC to clarify
there's inevitably guidance from HMRC, but inevitably, because it's subjective, it's not all that helpful.
Yeah. So there's more definitive tests, isn't there, which we'll move on to now.
Okay. Next condition: is it reasonable to expect that at least 80% of your remuneration, i.e., what you get for performing services for the LLP for a relevant period, and we'll talk about what the relevant period is in a moment, will be disguised salary? So disguised salary is something that is either fixed or it is variable, but it's variable without reference to the overall profits or losses of the LLP, or it's not in practice affected by the overall profits. So if, for example, you run a division of the LLP and your profit share is determined by reference to the profits of that division, then it's variable, but it's variable without reference to the overall profits.
So eat as you kill partners, although again, most of us probably walking down the street or on the Clapham omnibus these days would look at them and say, yeah, you're a partner. Actually wouldn't satisfy.
They wouldn't satisfy this test because then their profit is not, their share of profit is not determined by reference to the overall profits, or if it's not in practice affected by the overall profits. So you might have a partner with a fixed profit share plus a small percentage of profits in excess of a very, very large figure that is not realistically ever going to be achieved, and then those profits are then not in practice affected by the overall profits.
Okay.
Note that test is only relevant if you're looking at remuneration in respect of your performance of services for the LLP. So if your profit share is not determined by reference to services, for example, if you're on gardening leave, then this test doesn't apply. If you're a member of an LLP and you're not actually doing anything, but maybe you're providing assets to the LLP and your profit share is determined by the capital you've contributed, or if you're perhaps a retired member of an LLP and you stay in as an LLP as a deferred member with a fixed profit share that's akin to a pension, but you're not actually providing any services, and again, the disguised employment, this aspect wouldn't apply.
Okay, and we'll come back to this, but this isn't a sort of test once and forget about. This has to be looked at again. We'll come back and talk about what we mean in the relevant period shortly.
Well, it's looked at by reference to the period during which the remuneration arrangements exist. So if you look, first you look at when you join the LLP, but you then question whether the relevant period continues until essentially the remuneration arrangements are altered. So the example we've got here, partner A has fixed salary of £50,000 plus 5% of profit. Profit is expected to exceed £250,000 indefinitely, and the expectation is therefore that he would get £50,000 fixed plus 12.5% variable, which is okay because we passed the 80% test. Profits turns out the profits for a particular year are actually £200,000, so he gets £50,000 plus £10,000, and now more than 80% is fixed.
Right.
Less than 20% is variable, but we're still okay because over the relevant period, the expectation was, the reasonable expectation was that the test.
So there's still a degree of subjectivity in there, isn't there? Because it's about expectation rather than the actual numbers. So. And the assumption there is these 5% of profit is the profits of the overall partnership.
Absolutely, yes,
as well.
yes.
Okay, so I think we've got one further example just to flesh that out in a little bit more detail.
This again is illustrative of the relevant period. So we've got a project that is expected to last for 4 years. So what we're looking at is the expectation of profit over that period. So the guy receives, or the lady receives £50,000 of profit plus £50,000 a year, plus 25% of profit. And it is always expected that in years 1, 2, and 3 there will be minimal profits. So in years 1, 2, and 3, the profit share will the fixed element will exceed 80% of the total profit. But the year 4 profit is expected to be £400,000. So over the relevant period, the total expected remuneration is expected to be £300,000, of which the fixed element is £200,000. So we are okay because the amount that is varied by the LLP profit is a third of the total. So the fact that we all know, or we know from the outset, that we're not going to pass the test in years 1, 2 and 3 doesn't matter, because what the test is for the relevant period as a whole.
Okay, so I think there's also a certain, I wouldn't say obligation, but recommendation about record keeping, etc., etc. You might have to justify this to HMRC by reference to the decision at, well, year 0 in this point. So if profits fall, you might have to show HMRC actually what we took was a reasonable view at that point in time. So do keep records, and Daniel, I hope that clarifies your query given the examples we've now done. Okay, so that's condition, what was that? That was condition A, wasn't it? So now we move on to your final choice.
Final condition now is, remember that we said there were broadly 3 characteristics of being a partner. Being a boss, i.e. the significant influence, having a share of profit, which is the condition we just talked about, and the third one, having something at risk, having capital tied up in the business. And this is condition C, where the members' partnership capital, as at 6th of April, needs to be, in order to avoid being a disguised employee, the members' partnership capital needs to be more than 25% of the amount reasonably expected to be disguised salary for the year. Unlike the previous condition, this is a year-by-year test.
Right.
Obviously, it's pro rata for short periods, and by capital, the legislation is talking about long-term finance, not short-term loans that can be drawn out while you're still a member. The legislation has provisions which counter arrangements intended which are intended to present the illusion of capital at risk when there isn't really capital at risk.
Right.
So if, for example, the capital is funded by a limited recourse loan that is guaranteed by the LLP as a whole or by the other members of the LLP, so that the member in fact really has no capital at all at risk, then condition C is not going to be not going to help us. For a new partner joining, there's 2 months grace for putting the capital in after joining.
Yeah, in simplistic terms, this is the revenue's way of saying we think partners put money into a business, so show us your money.
Show us your money, indeed.
Okay.
So there we are with disguised employees, and there is a new style, a modern targeted anti-avoidance rule, which broadly speaking says that if you're a member of an LLP, then anything you do that is aimed at avoiding the impact of the rules doesn't work. There's provision says that if any arrangements that are put in place with the purpose of no regard is to be had to any arrangements, the main purpose, or one of the main purposes of which, is to ensure that section 863A2 doesn't apply in the case of the individual. So whatever you think you're doing doesn't work.
Yeah, and you've given a specific example there. You can't sort of hide behind your personal company to try and get around these rules either. There's a specific
provision relating to a company, because companies, of course, can't be employees, and companies, of course, therefore in principle can't be disguised employees either.
Right.
But there's a specific provision that says that if you've got a company with a fixed profit share, then the same sort of rules apply. And as we say, different rules apply for ordinary partnerships. We're talking here solely about fixed profit shares in LLPs. In ordinary partnerships, the usual rules as to whether you are an employee or not apply.
Okay. So far, so good. So those are the salaried partner rules. There were some other provisions that were introduced at the same time. The mixed partner rules.
Before we move on
to that, go on
about the gig economy cases.
Oh, go on.
Now, what about gig economy cases? We now have effectively 3 categories of person.
Yes, choose your words carefully.
Yes, 3 categories of person. You've got people who are principals
Yeah.
in business, self-employed. You've got employees.
Correct.
You've also got this category of worker under the Employment Rights Act and equivalent legislation, which of course is the legislation that people have invoked, whether they're plumbers or couriers or what are the other ones that have been involved in these where people are not employees, but notwithstanding they're not employees, notwithstanding they are self-employed, they invoke the legislation to give certain rights that are applying to Limb B workers. Now, I'm not aware of any cases in which those Employment Rights Act cases have been invoked in the case of people who are partners in a partnership,
right?
As self-employed people, but it seems to me there is no legal reason why a partner in a partnership could not, or indeed a member of an LLP, although not an employee and though not a disguised employee, there seems to be there's no reason in law why such a person couldn't be a Limb B worker. Not a tax point. Because in tax we're only concerned about whether somebody's employed or an employee, employed or self-employed. But it's just an interesting point, I think, to be aware of the application of those gig economy cases to fixed share partners.
Okay. As a slight aside, we've been talking about partners and members of LLPs, and I think most of us in our day job use the two words fairly interchangeably. Is it specifically defined in the legislation? I mean, where the legislation talks about a member, can we, as a partner, can we assume automatically that that also refers to members of LLPs? Because I haven't seen it, and I'd be interested to know your views, David.
There is a provision that says that in the Act that says that where the Act talks about a partner in a firm, then that is to be taken to refer to a member of an LLP as well.
Right.
But it's not completely clear that everywhere that partners are that the term partner and member are interchangeable in every circumstance. In particular, the point arises in terms of connectedness.
Yes.
Partners are connected with each other.
Yeah.
Whether members of an LLP are connected with each other is not completely clear. I think the better view, and probably the consensus view, is that members of an LLP are not connected with each other because they are legally much closer to being in the same position as co-members of the same company.
Right.
So there's no more reason for members of an LLP to be connected than for co-shareholders in the same company. So the jury is still slightly out on that, but I think, and I would quite like to, if anybody has an argument with the revenue they'd like to take up, I'd be delighted to pursue it, because I'd actually quite like to have a concluded view on that.
Yes, I mean, we've looked at it in the past, I think, in the context of associated companies, but that has somewhat died a death. Now we've got a flat rate of corporation tax. Okay.
So that's all about LLPs and disguised employees.
Right.
I think.
Yes,
so we
indeed.
Can talk about something else entirely different.
All right.
So draw a line under that, and now we'll talk about compliance for partnerships and LLPs.
Fire away. So,
and there was actually one very interesting point that where there was an LLP that was a penalty for revenue seeking a penalty for failure to comply with a notice to file a return, and the tribunal concluded that the legislation that requires partners to file returns doesn't actually apply to LLPs.
Oops.
Because of a drafting error. So the penalty was not upheld. But I think that was a bit of a unique view. I don't think I would want to rely upon that. So generally speaking, most people accept that the legislation that requires partners to file tax returns, so partnerships to file tax returns, also requires LLPs to file tax returns.
Right.
It's a bit of a bit of a unique view to say that it doesn't apply to LLPs.
Fair
But
enough.
nonetheless, interestingly, I think it is fairly clear that most notices that the revenue issue to, well, most notices to file a return that the revenue issue are actually technically invalid.
Why is that, Mr. Whiskey?
Well, it's because under Section TMA 1970, the revenue have essentially two alternative ways of requiring a return of partnership profits under Section 12AA2 and
Right.
Section 12AA3. And they can require under Section 12AA2 a notice to be issued to the partners requiring such person as is identified in accordance with the rules given with notice to file the return.
Yeah.
Or under 12AA3, they can issue a notice to any partner to file a return. In fact, what is filed under each of those notices is actually slightly different, but that's mere detail. So it's important to note that a return of partnership profits is made by a person. It's not made by a partnership. There is a partner who signs off on a partnership return. It's either the partner to whom the notice is issued, or it is the person identified in accordance with the rules given with the notice. And if we look at the next slide, we'll see a typical notice issued by the revenue.
There we go.
Happens to be issued to Burke Capra Lewis.
Yeah.
And so that purports to be a notice that is issued under Section 12AA2, a notice to the partners,
Yeah.
is in the partnership name, requiring such person as is identified in accordance with the rules given with the notice. The slight problem is that there are no rules given with the notice identifying who it is that's supposed to issue the return. It's issued to the partnership, but it doesn't say which. Not only does it not say which partner, it doesn't give you any clue as to how to work out which partner is supposed to file the return. So I technically, because that's the standard that the revenue use, I suspect that it's actually not a valid notice. I don't recommend that you ignore them and simply don't file any partnership returns, but it just does seem to me that in a tatties over the side situation, in an absolutely last desperate stand against penalties, it's if you're going to throw in every other objection to a penalty notice for failure, then you could actually put that forward as a
Yes. And they've missed LLP off our name, so.
Yes.
Right. So last resort only.
Last resort only, bit interesting point. Next, penalty for failure to notify. Can a partnership be penalised for failing to notify liability? Well, no, because the obligation under Section 7 is that any person who is chargeable to income tax or capital gains tax has an obligation to notify chargeability. And of course, a partnership, as we all know, isn't chargeable to income tax or capital gains tax. The partners are chargeable. So there is no obligation legally on a partnership to notify chargeability. There is, of course, an obligation on the part of a partner if he or she has a profit share. Then he has his own obligation. But again, it's best practice to notify, but there is no penalty for not notifying the case of a
All right.
partnership.
So if you want to pick a fight, but not worth it.
It's not worth it.
Okay. Now, let's have a quick word about time limits for filing. We all know, David, surely 31 January. That's all you need to know, isn't it?
Well, yes and no. Yes and no. Where there's a company partner, Section 12AA5 applies, and the return has to be filed within 9 months of the end of the relevant period if it's filed on paper, 12 months from the end of the relevant period if it's filed electronically.
Okay.
Relevant period, reasonable question. What is it? Well, the relevant period is defined as the period in respect of which the return is required. And what is the period for which the return is required? Well, the problem is there actually isn't a defined period in respect of which the return is required, because typically a notice, as is set out in subsection 8, may require different information, accounts and statements for different periods, and typically does.
Yeah.
It wants a return of profits for the accounting period, but it typically requires a return of profits for the tax year, for the 5th of April year, for example, capital gains.
Yeah.
So a return actually doesn't specify a period in respect of which the return is required. It specifies several periods. So it seems to me that, strictly speaking, again, as a last resort argument, if you are filing a tax return, a partnership tax return of a partnership which has a company partner, then electronically, for example, you can never be late, provided you're filing within 12 months of the end of the tax year, by 5th of April. Again, I don't recommend it as a strategy for deferring filing all of your partnership tax returns to have corporate partners until 5th of April. But if you are in the position where there is a dispute as to what the time limit for filing is, then it's worth doing it.
All right.
And certainly if the accounting period is later than 31st of January, then there's no doubt about the fact that the extended filing date applies, because on any analysis of what the period in respect of which the return is required is, it's later than 31st January, therefore the filing date is later than.
No, I was just having a look through the Revenue's own notes on completion of partnership tax return. Certainly doesn't make that clear that there may be an extension for corporate partnerships as far as I can see. But there you go. But it's worth a try, isn't it?
But certainly there's no doubt about it that in the case of a corporate partner with an accounting, and you've got an accounting date later than 31st January, you've got an extended filing date. If you haven't got a accounting period later than 31st January, then
it's a bit more juicy. I think it's fair to say if you have a February year end, expect a penalty from HMRC, but we think you've got grounds to appeal against that.
Yeah, yes. Let's say no more than that.
Okay, all right. Much to cover, so let's crack on. Unusual partners, David. What do you want to tell us about?
Unusual partners. Well, again, firstly, there's some doubt about whether you can be a partner as a nominee for somebody else, or indeed a member of an LLP as a nominee for somebody else.
Right.
And some on the consultation document that was issued in 2016, I think, there was discussion as to how these things would be resolved. FA 18, Schedule 6 of FA 18, now makes provision for how you deal with partnerships who have partners who are nominees, or partnerships which in turn have partnerships as partners. So taking nominees first, if you have a partnership where A is a member but A is a nominee for B, then the tax return is now required to include B as a partner. Or what the legislation says is that the term partner includes a nominee for a partner, as well as somebody who is the beneficial owner of a partnership interest. So the partnership return, the legislation now says that apparently that you need to include both, it seems, the actual partner and the beneficial partner, and show the profit shares, presumably allocating a nil profit share to the nominee and an appropriate profit share to the beneficial partner.
Okay.
The difficulty there is I'm not sure how the partner filing the return necessarily knows that one of the partners or one of the members of the LLP is acting as nominee for somebody else. So there seems a practical difficulty on that. So we'll wait. This applies for returns for 1819. So we'll wait and see what the guidance notes for the 1819 return say.
Okay, fair enough.
Partnerships as partners, again, originally the Revenue considered it was not possible for a partnership to in turn be a partner in another partnership. So it was a bit surprising that FA 18 produced legislation dealing with how to make returns where a partnership is a partner in another partnership. And the difficulty historically has been that if I'm filing a tax return for a partnership, and I've got some individual partners, and I've got some corporate partners, and I've got some non-resident partners, and I've got some non-resident corporate partners, the basis on which the partnership profit is computed may be different for each of those four categories of person.
Yeah.
So, and in principle, if I've got those four categories of person as partners, in principle, I need to do four different partnership computations with four different sets of rules and allocate the profit to the appropriate class of partner in accordance with the profits computed that are relevant to that class of partner. If I've got a partnership which is a partner, then I don't know necessarily how to allocate the basis on which to compute the profits to allocate to that partner. If I've got a partner, one of whose members is a part, if I have a partnership which is a partner in my partnership, and that top level partnership has one resident partner and one non-resident partner, then do I allocate the profit share to the partnership or using the residence rules or the non-resident rules? Well, the legislation says, well, I've now got to allocate profit using all four bases, unless as the person filing the partnership return, I make a declaration identifying the names of the partners in the top level partnership, if you like, and their status as individual resident, non-resident, company resident or non-resident, in which case I'm then absolved from filing a partnership computation computed on what I have demonstrated to be an irrelevant basis. So it's all a bit of a paper chase, but it's all, I was going to say, clearly set out in Schedule 6. It's all set out in Schedule 6. So you've now got a set of rules saying what you do if a partnership is a partner in your partnership.
All right. I know we've had discussions with HMRC on this in the past, haven't we? Whether the treatment of that, how do you look through all the nested chains of partnership? So at least we have a little bit more clarity.
We now know what the rules are.
Okay. All right. So that's
more importantly, the revenue know what the rules are.
Well, whether they, yes, indeed. Okay. I think we want to move on now to inquiries, because this is also can be quite a tricky area, can't it?
Yep. Revenue can make inquiries into any return, of course, including a partnership return.
Yep.
Notice of inquiry has to be issued to the representative partner, which is essentially the partner who filed the return. Which goes back to what I was saying about a partnership return is signed by a partner, by a person. So there's a notice of inquiry has to be given to the partner who filed the return. There's a case called flax mode that demonstrates that some flexibility is allowed. Flax mode sought to take the point that the revenue had issued the inquiry notice to technically the wrong person. And the tribunal said, well, look, you made these arrangements so complicated that you didn't know who the representative partner was half the time. And it was absolutely plain everybody knew the inquiry had been issued. Everybody knew what the revenue were inquiring into. So we're not taking the point that we're not allowing you to take the point that the notice may have been issued to technically the wrong partner. They all have the same registered office address, so no, we're not going there. So there is some flexibility allowed. When the revenue issue an inquiry notice into the partnership return, Section 12AC6 deems there to be an inquiry into the partner returns, the individual partner returns, the partner returns made by each of the partners. Or indeed, if at the time that the partnership return is made, the partner's returns haven't been made, but are subsequently made, then if by the time the partner return is made, the partnership return is already under inquiry, then the partner return is deemed to go under inquiry simultaneously with being submitted. So it's a deemed inquiry into partner returns that have been made or to be made in relation to the partnership accounting period. Revenue always, in practice, tell other partners when they've raised an inquiry into the partnership return, but they're under no legal obligation to do so. They consider it to be good customer service.
Bless them.
Well, yes. One of the points that has been subject of some interest is that Section 9A3 says a personal return that's been the subject of one notice of inquiry may not be the subject of another notice of inquiry. So where does that leave you if you have a deemed notice under Section 12A6 because you're a partner and there's been an inquiry into the partnership return, so it's deemed to be an inquiry notice under Section 1206. Well, does that allow the revenue to issue another inquiry notice into non-partnership aspects of your return, or does the deemed inquiry notice cover everything, or how does all that work? And only fairly recently it was resolved in Reed and Emblin, where the taxpayers asserted that they took the point that Section 9A3 says you can only have one notice of inquiry. So if you've closed, so if there's been a partnership inquiry,
yeah, and
that's closed, then the revenue can't then open another inquiry into non-partnership matters. And they were sent away from the tribunal with a bit of a flea in their ear.
Sounds fair enough. To be fair, I hate to admit it.
And the tribunal said, "No, don't be ridiculous.
Yeah.
There's a deemed inquiry and an actual inquiry are two different things. The deemed inquiry covers only partnership matters, and an actual inquiry covers everything else. But one of the interesting points is the revenue accept that they accept the deemed inquiry covers only partnership matters. So if it covers, for example, an inquiry into the proceeds of an asset for capital gains tax purposes of a partnership, because the proceeds are disclosed on the partnership return, but the gain isn't disclosed on the partnership return, because the gain is computed at the individual level. So the revenue accept that if they want to make any inquiry into the capital gains tax consequences for an individual partner of a disposal of a partnership asset, then they need to make a separate inquiry into the partner return if their inquiry relates to, for example, the base cost or the entitlement to entrepreneurs relief or whatever it may be, because that is not essentially a partnership matter. So it's sometimes the case that the revenue will need to make both a deemed inquiry and an actual inquiry in order to cover all the ground.
Fair enough. Okay.
Closure notices, of course, an inquiry into a partnership return is terminated with a closure notice. The closure notice given to the representative partner, i.e. the person to whom the inquiry notice was given. Who can appeal against a closure notice? Well, there's case law that says that not only can the representative partner appeal, any partner can appeal against the closure notice because they have a legitimate interest. Now, when there is a when there is a closure notice closing an inquiry into the partnership return, then that is deemed that is deemed to create a consequential notice that amends every partner's return, every personal return, and by implication closes the deemed inquiry into the individual member's return, the individual partner's return. And interestingly enough, there is no appeal against that consequential notice.
Right.
So if there's an inquiry into a partnership, inquiry trundles along, revenue issue the closure notice, there's no appeal against the closure notice, and then consequential notices are issued, then there's nothing you can do about it. And interestingly, there's no provision for postponement of tax against that consequential notice amending the personal return, even if the closure notice is appealed. And so to get over that, it's normally the case that the revenue don't issue the closure notice, don't issue the consequential notices amending personal returns until after any appeal against the closure notice is final.
Yeah.
So that's how that works.
Okay, so as always, be careful who you're in partnership with. I think is the unwritten story of a lot of this, isn't it?
It is, and it's quite surprising how few partnership agreements have any reference at all to who's going to file the return, what their obligations are, what sanction the other partners have to make sure the returns are filed, and all the rest of it. It's almost always silent in the partnership agreement, the matter of dealing with revenue compliance.
And on a related matter, penalties, albeit this is potentially subject to change going forward as far as quantifying the penalties, but they can be very severe in partnership cases, can't they?
They can be, because well, they can be, but there is some good news as well on partnership penalties. A partnership as such is not liable to a penalty for late filing of a return or for errors, because a partnership, remember, is not liable to make a return. A partnership is not liable to pay tax. A partner is liable to make a return, and partners are liable to pay tax. So the penalties focus on the partners, not on the partnership. But where a but each of the partners is liable for penalties for late filing and for errors. So if a return is filed late, then not only is the partner to whom the return is issued liable for his £100 penalty, every other partner is also liable for his £100 penalty. And that's in addition, of course, to any personal penalty there might be for the partner filing his return late, because he might have filed his return late because he didn't know what the partnership profit share was to put on his return to file it on time. So although partners are individually liable, only the representative partner has the right of appeal.
Okay. Enough said, Mr. Wiscombe. But there have been some changes in Finance Act 2018, just to update everyone.
Yeah, there are a number of changes we've already spoken about, including the changes on partnerships as partners, on nominees as partners. The other change that's quite interesting is what happens if you disagree with the partnership return. Well, imagine you and I are in partnership. Imagine you file.
Stranger things have happened, yes?
Indeed. Imagine you file the partnership return.
Yeah.
Your name is on the return.
Yeah.
You take responsibility for it.
Signed in blood, yeah.
And so you file the return, and you allocate a share of profit to me. And I say to you, well, actually, Tony, your return's just wrong. That amount that ought to have been deducted, you haven't deducted it.
Yeah.
I think it's fully deductible. No, absolutely no doubt about it. So I think the allocation of the partnership profit return is wrong, which is fine. That's your problem. You signed the return. But more importantly, the profit that you've allocated to me is wrong.
Mm-hmm.
Now I've got to file my personal tax return, and the legislation says two things. One, it says I've got to put on my personal tax return the allocation of profit that it was on the partnership return. It also says I've got to sign a declaration that my return shows a true and fair view. Well, what if I don't think it does show a true and fair view? Which takes priority? Well, this was what happened in the cases of Morgan and Self and in King. What happened was that the courts said, or the tribunal said, what I must do in that situation is I must disclose on my tax return what I believe to be the true and correct figure, but I must also disclose the figure that was on the tax return. I must explain why I think the two are different. Okay. So that's the position up to FA 18. Now that was regarded as not wholly satisfactory, not least by the Revenue, who didn't follow their own practice in the case of King, but that's another matter. So the legislation was changed in FA 16 to put a new code in place. And from 2018, these new rules apply. Partnership return is conclusive as to the amount of the profit share. If there is any dispute, so if I think the profit share is wrong, then the matter is referred to the tribunal. I refer it. You as the person filing the return get to go to tribunal. Revenue get notified, so they could turn up and say their piece. There's a formal tribunal provision where essentially the tribunal operate to referee between you and me as to what is in fact the correct. It's an incredibly cumbersome situation, incredibly cumbersome device. My theory is that it's been drafted in that way to discourage anybody from ever taking a partnership dispute of that kind to the tribunal.
Yes, and it's similar to the rules on capital allowances, aren't they, for fixture and fixture election? You can go to the tribunal there. I've yet to see a single example in the 2012 those rules came in, didn't they? So 6 years. So, okay, the principle is there.
However, having said that's the principle, the legislation says that this new procedure doesn't apply if the dispute is in substance a dispute about the amount of the partnership profit or loss. It's only about disputes between partners as to profit share, as to, for example, whether I'm a partner at all, or whether the amount of profit that's been allocated to me is in accordance with the partnership agreement, or that sort of thing. If the dispute between you and me is actually what figure ought to go on the partnership return as being the case one or case two, those were the days, the trading profit or the professional profit, then these new rules don't apply. So we're then thrown back onto what I described in the Morgan and Self situation.
Okay, again, be careful who you get into bed with, as it were. Right, time marches on, David. So let's have a look at partners' personal expenses in quotation marks.
Yes, well, when I say personal expenses, I don't mean personal expenses.
Yeah,
I mean
obviously.
expenses relating to the business. So HMRC practice at reference adjustments are made before apportionment of the net profit between the partners. So if you and I are in partnership and I, for example, run my car entirely out of my pocket, but I do some partnership journeys. I do some journeys on partnership business, so that I have incurred some expenses holding it exclusively for the purpose of the partnership business, but don't go through the partnership return, partnership accounts. Then it is permissible and acceptable, and it's revenues practice that I can make that adjustment to the returned profit. So that's so I can adjust I can take relief from my personal expenses. It's always slightly odd whether that's that's long established practice. It's never been disputed by the revenue. Everybody accepts that that's the case. No problem. Question: is it actually consistent with ETOIA, which says the partnership profits have to be computed in accordance with GAAP? Well, if you've got an LLP and either the profits in the LLP, without making adjustment for member expenses, either those profits are computed in accordance with GAAP or they're not. If they're not computed in accordance with GAAP, then it seems to me the LLP accounts are wrong.
Yeah, you're saying don't show a true and fair view because they're not got all the costs in there.
Exactly. And if they do show a true and fair view, then I'm not sure on what basis I can then make an adjustment separate and outside of the accounts. So it's a bit of a now. That seems to be a theoretical difficulty rather than a practical one. But one of the things that came out in that consultation document and draft legislation following the consultation document was a proposal that taxable profits would be allocated in the same ratio as accounting profits. That was draft legislation. Didn't appear in FA 2018. Now, I'm not sure how that works when you've got expenses that are incurred at the partner level, because by definition, the taxable profits won't be allocated in the same ratio as accounting profits because they're not accounting profits and they're outside of the whole edifice on which accounting profits are based. So that may be why the revenue have reconsidered that provision that talks about allocating taxable profits in the same ratio as accounting profits, because that doesn't seem consistent with personal expenses.
Okay.
But it seems to me that to get rid of all of this complexity, perhaps the thing to do is to charge the expenses in the accounts, credit them back to the member or the partner, allocate the partner the profit share accordingly, so that everything is actually in the accounts, and then you don't have this same difficulty perhaps with GAAP or ETOIA or they allocated the draft legislation that never went through. So that seems to me that might be the way around it if it's going to become a problem in the future.
Okay. All right. Ladies and gentlemen, please cancel your 2 o'clock meetings. I suggest we'll need another 10 minutes or so, but it's all good stuff. So do stay with us. We know who you are. Let's move on to corporate partnerships then, David.
Corporate partnerships. No reason why I can't have a company as a member of a partnership, have a company as a partner in a general partnership, a member company as a member of an LLP, or indeed as a limited partnership. Let's not talk too much about tax deductible from interest paid because that's a bit peripheral.
Okay.
Let's go on to the next slide and talk about the rules on mixed member partnerships. Now, the background to this is that if I'm a trader, if I'm a sole trader, I can perfectly legitimately incorporate my business.
Correct.
Even if I'm doing it wholly for tax reasons, I want to pay tax at corporate rates on retained profits. Is there and conceptually, there's not really any reason why I shouldn't, as a partner in a partnership, incorporate my partnership interest. So instead of being an individual member in a partnership, I have a company as a member in a partnership. That seems to me to be that's reasonably innocuous. It's just sensible planning, no more tax avoidance than incorporating a sole trade, it seems to me. But inevitably, once people started doing that, there was more aggressive use of mixed member partnerships, so that I might be a member of a partnership alongside my limited company, and I might allocate all of the profits to the limited company, so they pay tax, corporation tax rates, but I might actually then suck money out of the partnership individually, so that I personally enjoyed the profits, but the company paid corporate tax on them. And there were various schemes of that kind. So in 2013, the Revenue's response was to bring in this mixed member partnership rules, and they apply where you have a partnership or an LLP where an individual member A, a non-individual member B, usually a company but not necessarily a company, and one of two conditions apply, but they may overlap.
Okay, so let's have a look at those two conditions then.
Condition X is reasonable to suppose that deferred profits of A, the individual, is included in B's share. And deferred profit means any remuneration or benefits, the provision of which to A has been deferred, even if it's subject to conditions, and even ultimately if A may never get it. So if something that is even potentially my profit share gets allocated to a limited company, then essentially that whatever amount of that deferred profit share is allocable to me on a just and reasonable basis, right, is taxable on me. There's no motive test. It's all that's required is that there is a saving of tax. There's no requirement that I shall have a legal interest in the corporate member, and even worse, there's no adjustment if the deferred profit share is never paid to me, because the fact that it was potentially mine is sufficient to bring the rules into play.
So, as you say, very broad-reaching these provisions potentially, and not entirely equitable. I think the one we tend to see a little bit more of is condition Y, though. Would that be? Condition
Y is more, but the two very often overlap. Yeah. But condition Y is the more common one. So B's profit share exceeds, that's the limited company's profit share, exceeds what the legislation calls the appropriate notional profit, which is, as defined, a reasonable return on capital and a reasonable consideration for services. But you ignore services that have been provided involving individual partners themselves. So if I'm a partner in the partnership and my company is a partner in the partnership, then the appropriate notional profit that can effectively be allocated to the company is only the profit that is attributable to staff that the company has done independently of me. So it might be that the company has lent money to the partnership, right, or it might be the company owns assets that have been used by the partnership. But I can't argue that the company has done lots of stuff for the partnership because I'm a director of the company, because that's you have to ignore services involving other partners. So the company's profit exceeds the appropriate notional profit. An individual A has power to enjoy the B's profit, and here think broadly transfer asset abroad rules, right, which means any circumstances in which A can get hold of the money, or anybody that A likes can get hold of the money. Frankly, it's power to enjoy incredibly widely drafted. And it is reasonable to suppose that at least part of the company's profit share is attributable to my power to enjoy it. Would the company have had that profit share allocated to it if it wasn't for the fact that I was back there as an éminence grise expecting to get my sweaty paws on the company's profit share at some point in the future?
In most cases, quite clear. If you sort of replace David Wiscombe with David Wiscombe Limited in the partnership, that's absolutely going to get caught.
Well, you say replace.
Well, okay.
These are alongside. Remember, yes, mixed member rules. Remember these are mixed member rules. So it is a requirement going right back to the beginning that you have an individual member and a non-individual member. So that's quite important. So that's condition Y.
And the consequences?
You reallocate from the individual to A on a just and reasonable basis, whatever is just and reasonable. And it can be quite nasty. I mean, there's one bit partnership that we looked at where B had been a member of a partnership for historically before 2013, had suffered losses of the partnership.
Yeah.
Post 2013, it was a mixed member partnership. Profits got allocated to the individual, And so those losses that historically have been allocated to the company were never going to be used because the company was never going to have any profits allocated to it. Now we suggested to the revenue in those circumstances it wasn't just and reasonable to allocate, but the revenue were having none of it.
No surprises there. So just picking up on what we were just discussing before, there is further anti-avoidance.
There is further anti-avoidance.
Yes,
this is the case where the individual A is not in fact a partner, and so Section 850C doesn't apply. But you've got a company with a profit share, and it is the wording of the legislation. It is reasonable to suppose that A would have been a partner, but for the rule. And condition A or X or Y is met. Then what the legislation tells you to do is to treat the individual as if he were a partner, and then the consequence of that will be that the profit share of the individual of the company is reallocated to him. But in this question about reasonable to suppose that he would have been a partner but for Section 850C, well, would he have been? Well, yes, if he's an indirect partner. The legislation specifically says that if you are a partner in a partnership that is a member of the partnership, then you've only done that to avoid Section 850. So that's clear. But other than that, it's not at all clear what is meant by Section 850D. If you were previously a mixed partnership, right? David Wiscombe and David Wiscombe Limited were members, and you resigned. The individual resigns following the legislation. Then it's reasonable, I think, for the revenue to say, well, you would have been an individual member, but for the change in legislation. Agreed. Therefore, Section 850D applies. What if you resigned in anticipation of the legislation? You saw the draft legislation in 2012, and you said, hang on, I can see which way the wind's blowing here. I better resign. Well, would I have been a partner but for Section 850C? Well, the revenue say, well, no, you wouldn't, because you can't have. It can't be the case that you would have been a partner but for the legislation, because at the time you resigned, you didn't know the legislation was going to be enacted. So that's okay. Resigning in anticipation of the change is fine. What if you've always been only a corporate member? Well, that must be okay, because if you've never been an individual member, then it cannot be the case that you would have been a member but for Section 850C. Yep. What if you join a partnership of fully corporate members? Would you have been an individual member but for Section 850C? Well, probably not. Because if nobody has ever been an individual member, why is it reasonable to suppose that you would have been a member? Though I have had an exchange of revenue with the exchange of correspondence with the revenue, which suggests that they kind of think that Section 850D is a kind of wide spectrum antibiotic that allows them to strike down any sort of corporate partnerships they don't like the look of. Now, I think that's just wrong. Yeah. But there has been, as far as I know, been no case law on any of this mixed member partnership rules. So it's we're still 5 years after the event, still guessing a bit. And as always, the legislation seems to be deliberately vague these days, doesn't it? Just to keep us all on our toes. There is legislation that says that where you have been allocated a part of the corporate member's profit share under the anti-avoidance rules, then you can suck out the profit from the company without further tax consequences, which is actually only fair, because if the company's got money that you've paid tax on, of course you'd expect to be able to get your hands on it without any further tax consequences. I think all I would say is that it is not as straightforward as it ought to be. There has to be an agreement in place which relates to the excess part of the profit share, and as a result of the agreement, the company makes a payment out of the excess, and it's not made under tax advantage arrangements. Then you can get it out without a tax charge. But it raises as many questions as it poses. What if the payment's made before you make the agreement? What if the company has already used the money to make pension contributions, so you can't take it out? I mean, is that so you're deemed to be taxed on the company's income without relief for the pension contributions the company's made effectively on your behalf? The revenues say that if there's a single payment that's made out that is in excess of the payment that's attributable to you, then this relieving provision doesn't apply, which is ridiculous, but it's the revenue practice. There are rules. I mean, what happens if the payment's made by the parent company? So subsidiary company pays a dividend up, and that's not a payment that's made by the corporate member. It's a payment that's made by the parent, so that doesn't give you relief. So it's all a bit of a bit unsatisfactory.
All right, be careful.
So avoid.
We've had a question.
Really?
We have, from David, who says, David's asking, we talked about where you have a corporate partnership and you are allowed, the corporate partner is allowed to broadly keep a reasonable return on its capital contribution. What is that rate? I think the revenues guidance note talks rather...
It's risible.
Risible 2%, I think it is.
Yeah, I mean, the revenues guidance is clearly wrong. I'm sorry, I might say clearly wrong. I mean, I disagree with it. The question is, have I seen any disputes? I haven't seen any. I mean, I'm sure the revenue have raised questions. I haven't seen any questions raised with the revenue. As you say, the revenues guidance note suggests that 2% in the particular circumstances of the example was right. I think, and they do make the point that the rate should be an interest rate, not a risk capital rate. In other words, not a share of profit rate, but the rate that would be applicable if you were borrowing the money.
Yeah.
That said, if you're an LLP that is borrowing money unsecured to a partnership, to a limited liability vehicle with no assets, and there are no agreement for repayment on demand, I think if you went down to Barclays Bank and said, I've got no assets, I've got a limited liability vehicle, I'm not prepared to give you any personal guarantees, what rate of interest will you charge me? I think the first answer might be unrepeatable. The second wouldn't be 2%. And I think we have put in, I think you've probably put in as many as I have. We've put in shares of profit of double-digit rates of return that, as far as I know, the revenue haven't challenged. But we think that that's an appropriate rate of return because that's the rate at which you would need to pay if you were borrowing on the market, in the market. So it depends what is, in all the circumstances, an appropriate interest rate. And I'm sure it's not 2%.
All right, let's finish off. We're in the final straight now. CGT and partnerships.
Should we, rather than rush this,
yes.
Do you think we're going to do another session on this, aren't we?
Okay.
So do you think, rather than rush this, we ought to hold this over?
Oh,
I think perhaps we'll hold this over.
You are such a tease, David.
I know, that's me.
All right.
It fits well if we do another session, perhaps, on CGT, change of profit shares, entrepreneurs relief and partnerships. That's an interesting subject in its own right. Rollover reliefs for partnership, replacement business assets in partnership, capital gains tax in partnerships. I can just visualise.
When will the excitement end, David?
It never stops.
All right, should we do that next time?
So I think we'll do CGT and partnerships. We'll roll this forward. We'll do entrepreneurs relief, all of that, and we'll fix another date.
All right. I think we'll have a break in August for holidays, so enjoy, everyone. Wow, book me. Oh, there you go. You've got a thumbs up from David already.
Okay, so we'll do all that.
So September time, we'll be back with Aspects of Partnerships Part 2.
Yep.
For now, thank you all for joining us. Thank you for your comments. We will be circulating a copy of this webinar later today. If you want a copy of Partnership Taxation 2018 by a certain, I can't read the name, it is available now from, is it Bloomsbury?
Bloomsbury Professional, yes.
Yeah, and we'll be testing you all next time, but a jolly good read. So thank you for joining us. I hope you found that helpful. It's goodbye from me.
And it's goodbye from him.
Goodbye.